A lot of Americans are beginning to lose trust in the economic data that they get from the government and the Federal Reserve Bank because they feel like they're being lied to. Most of the economic data that we get says that our economy is stronger than ever before, but many Americans are not feeling it, which is why it's such a strange period in our economy because on one hand, our economic data is saying that our unemployment levels have fallen to 4.1%, which is some of the lowest unemployment in the history of time. Number two, we have wage growth that is coming in faster than expected. Number three, inflation has been cooling steadily and is no longer a concern according to the Federal Reserve Bank. And number four, our GDP, our economy is still growing like crazy. The third quarter GDP numbers came in very hot, which means our economy is still growing. But many Americans are not feeling this good news because the average American says, well, what about us? Because every month we get a new report saying credit card debt just broke a new record high. We keep hearing the auto loan delinquencies are at the highest levels now since 2010. And savings rates, excluding the pandemic, are at the lowest levels we have seen since 2008 because Americans just don't have the money to save. And so I want to break this down because there's really two things going on here. It's a tale of two stories, where on one hand, investors are making more wealth, getting richer than ever before, while the average person is not. The average person is feeling poorer and being left behind. Now, it's not a new story, but the story has really accelerated over the last 5 years. Because over the last 5 years, what we have seen happen between 2019 and 2024, wage growth has grown by 18%. Reported inflation is 23%. And the S&P 500, the stock market, has grown by around 85%. So incomes have risen between 2019 until now, but it hasn't kept up with reported inflation. And I say reported inflation because the real inflation that many people actually feel is a lot higher than the reported inflation, because reported inflation is 23%, but housing costs have gone up by 50 to 65% depending on where you live. Car insurance is up by more than 50%. Grocery prices are higher than that. So reported inflation is really just the average, but the real inflation that many people pay is oftentimes higher than that. So household income has grown by 18%, reported inflation 23%, but the stock market has grown by actually more than 85%, I'm rounding down here, by around 85%. And so on one hand, you have the average person who has seen their incomes not keep up with reported inflation, while the average investor has seen their wealth grow significantly faster than that. But this did not start after the pandemic. This has been going on for a while. It just really accelerated after the pandemic. Between 1971 to 2021, if you remember, our real inflation didn't accelerate until 2021. So between the 5 decades of 1971 and 2021, we saw household income grow by 600%. But the cost of a new car grew by 840%. The median home sold grew by 1,200%. And the price of a college tuition, 1 year in college tuition for a public university, grew by 2,000%. So the household income growth of 600% didn't keep up with the prices of things that people need. Not to mention that between 1971 and 2021, household income went from one person working to 2 people working. So now you have 2 people working, double the people working, and still the household income growth did not keep up with the price growth of things. And this is where my goal is not to talk about just the bad news. My goal is to help you to understand what's happening. That way you can capitalize on opportunities, because the reality is our economic system here benefits the investor. Yes, market crashes happen. Yes, recessions happen. Yes, bad things happen in the economy. But despite the recessions, the stock market is still booming. And we know that despite asset downturns, despite the recessions, the economy has continued to grow. And so if you want to win in this system, you have to be a smart investor. Now remember, our economy is made up of spenders in the economy, people like you and me and businesses, but it's also made up of the government. And this is where I want you to go a little bit deeper to understand what's happening in our economy. Because although many people feel like they can't spend the way that they could before because inflation has made everything so much more expensive, the government has been picking up that slack because we've been seeing an increase in government spending over the last few years to really help ramp up the growth of our economy. I'll show you exactly what I mean, but I want to remind you that my goal for you is to be a savvy investor, and if you want help trying to find smart investment opportunities, we built a product called Market Briefs Pro, which is a more in-depth research newsletter where every Saturday my team gives you a breakdown of a shift that we have identified in the markets to help you stay on top of these investment opportunities, to help you be a more educated investor. So if you are a stock market investor and you want to learn more about what Market Briefs Pro is and how it can help you, I'll put the link to how you can learn more. It's the video that you can watch, and if you like it, then you can apply for a content demo for Market Briefs Pro, and the link is for you down in the description below. In 2020, the United States government saw its largest national deficit spending ever because of the pandemic. In 2021, we saw the second largest national deficit ever because of the after effects of the pandemic. But then the third largest national deficit ever is going to be this year in 2024, years after the pandemic is over. Now the question is why? Is it because that the government wants to continue growing the economy if people can't keep spending? Or is it something else? And this is where you want to start thinking about this, because remember, when the government spends money, that impacts people. The government spends money to build bridges. That means contractors are getting paid, and these contractors now have money to buy a house, to buy a car, to buy groceries, and to buy whatever they want. And so if the government is spending money, it is ultimately a form of tax. But the government doesn't have enough tax dollars to pay for these things. Because remember, it's a national deficit. That means the government is spending more dollars than what they've generated through taxes. And so when the government is spending money, it's always a tax. Either it is a tax that you pay directly because they levy an income tax on you, or a sales tax on you, or a property tax on you, or it is a tax that you pay indirectly in the form of something like inflation. Because when the government spends money that they don't have, then that money has to be printed or created by the Federal Reserve Bank. The Federal Reserve Bank is the central bank here in the United States, and what they have the ability to do is create money out of thin air and then lend it to the United States government. So now when the government now has this third largest national deficit ever, that means that the Federal Reserve Bank has to fund that cost. And that trillion some dollars then has to be created and lent to the United States government, so that way the government can keep spending this money. Now in the short term, the government spending money is good, because that means they're gonna create more contracts, build more bridges, do more things, pay more contractors, pay more businesses. But they're paying them with these dollars that have been created out of thin air. It's not just being created through taxes. That's what the national deficit is. It's money that the government does not have. And so that means then that it has to be paid back in the form of inflation, and then it has to be paid back in the form of interest. Because remember, the national debt has to be paid back. Now, we all know that the government probably will never pay back all of the national debt, but the government does have to make payments on it. And they have to make payments plus interest. And the fastest growing expense that we have in the United States right now is, of course, our net interest expense. Because number one, we have racked up more than $35 trillion worth of national debt. But number two, the interest rate on that debt is so much more expensive today than where we were back in 2020 and 2021. Now, a lot of people are hoping that interest rates are going to fall, making the national debt a little bit cheaper. But what that will also do is allow the government to go out and borrow even more dollars, because now it's cheaper to borrow money. I mean, it's just like anybody going to Macy's or Gucci. If you can buy something on sale, you might want to buy more of it, even if you can't afford it, because that's what the average American does. And when the average American relies on debt, that means they're borrowing more dollars. And that's what the government is doing right now. So the question is, well, what's going to happen in 2025 and 2026? Now, of course, we don't know, because obviously we have an election coming as well, which could change the trajectory of this. But this is where you want to pay attention to what's happening in these shifts, because we know that this economic system is designed to benefit the investor. And we know that the average investor is much wealthier today than they were back in 2021. How do we know that? The S&P 500 is up by around 85%. Housing costs and rental costs are up between 50 to 75 or 85%, depending on which study you read. Wages are up only 18%. And so wages have grown, but they haven't kept up with asset prices, and they haven't even kept up with the average inflation costs. Now, what the Federal Reserve Bank is hoping for is that now that inflation is supposedly controlled, the goal is that the wage growth that we see in 2025 and 2026 and 2027, it will outpace the inflation rate. So if inflation is hypothetically 2%, reported inflation, and wage growth is 2.2%, that means the average person is becoming wealthier. That's what the Federal Reserve Bank is hoping for. But you got to remember, there was a big discrepancy in 2021 and 2022 and 2023 and most of 2024 between reported inflation and reported wage growth. And so it will take a long time to see that be corrected, if it even happens. And this is where, again, we have a tale of two stories going on. The average American is feeling poorer today than before. But if you want to be able to win in this system, you have to become an investor, because our economic system is designed to benefit the investor. And we know that investors are wealthier today than they were a few years ago, which is why if you want to continue winning, you have to become an investor. Now, I got to give you the disclaimer, because of course, markets go up, markets go down. Never blindly trust a random guy on YouTube. But despite the market crashes, despite the recessions, because yes, we're going to see market crashes and recessions in the future, our economy has continued to grow. And market crashes and recessions create more millionaires than any other time for those that are financially savvy. So I want you to be prepared and understand the shifts that are happening in the economy, that we can capitalize on whatever happens in the economy. Now, if you want some additional resources, again, Market Briefs is a free newsletter that I have that keeps you up to date on what's happening in the economy. And Market Briefs Pro is a more advanced newsletter. It's a research newsletter for those of you that are stock market investors. And I got the links to both of those down in the description.